All right, everybody, welcome back to Cashflow Chronicles. I believe this is number 78 or 79. We're going to talk a lot about rates today. Obviously, JPowell say no cuts for you. It is March 20th of 2024. Market after JPowell had his conference post the FOMC meeting did a quick rally. So that being said, NVIDIA is back above 900, pretty substantially above 900, by the way. Dutch Bros is just below $35. If I remember correctly, the SPY hit 521 after hours. Apple's back the mid 170s. The Qs going close to 450. Palantir back above $25 after hours. Google is not zero. It's $149. Amazon closing in on 180 per share. Bitcoin also going up a little bit over the course of the day, up about 5%, 67, almost 68,000. And then WTI retracing a little bit, 2% compared to yesterday, back down to the low 80s at $81. Today, three main topics. Obviously, we'll get into the public portfolio. So very excited to do that. We didn't have the opportunity to do that yesterday. So Chris and I will take the opportunity to do that. We'll talk about JPowell, obviously, his comments. And then we have a Rocket Lab launch going on at 2 a.m. Eastern time, 1 a.m. Central time. That's pretty cool over in Virginia. So midnight launch pretty much for them in their second launch pad in Virginia. I'm trying to decide whether or not I will actually stream that or not. Probably not, but we will see. Mr. Patel, anything for you?
No, man, today was a good day in the market, primarily because I think we're seeing a paradigm shift in narrative, but more importantly, we're getting some conflicting data where real-time data is showing something, and then the data that the Fed is making their decisions on is materially different. So it's just weird to see, but I would trust JPowell because he's got the power to actually make the decisions. So so the example that I would give is, like, I'm looking at the inflation rate on the Cleveland Fed nowcasting data, and that's showing that we're actually reaccelerating inflation. And then on top of it, you're seeing oil prices starting to climb back up again as well, ahead of the summer driving season. So, a lot of this stuff is not, I mean, WTI did take a nice little pullback today slightly, which is encouraging to see, but Brent is at almost like at 86 today. If you look at the forward contracts on Brent, it's almost at 87. So like I said, this is a bit worrisome in my opinion, but what do you think about that?
I don't think it's too big of a deal. I mean, I know it's something that contributes to the CPI, but I don't think it's as large of a problem. If it started to come back into the 90s, I think it might be more. But you have to think it's a fraction of, right? So if you think of, yes, we're up, let's just say, 10%, even over the course of the last 2 to 3 months, because it didn't climb from low 70s to the low 80s, overnight, right? It's happened over the past, say, 2 to 3 months. And if you think about it in that perspective, that's a 10%, and then you divide it by what is actually oil and the energy prices for the total of the CPI. So I'm not saying you're wrong by any means. I just think it might not necessarily be too crazy. But the thing I do agree on, which I can never predict oil price, but the thing that you're stating is it is March, right? So you hit it on the head with respect to, there's not a lot of oil production. It's mostly gas production that goes on, natural gas production usage, demand. I mean, natural gas demand that goes on in kind of the colder months. And like you stated, as more people drive in the summer months, people go boating, people, do cross-country road trips, etc. Usage definitely goes up in the summer. But at the same time, we do have 13 million barrels a day getting produced here in the U.S. OPEC, I think the only reason why we might be seeing these $80 prices is because they're artificially curtailing rates. So even the thing that's kind of bothering me is somebody that's in the business and actually, looks at this on a day-to-day basis, and will continue to look even more so as I move into my new role.
Wait, so you got the job? You got the job?
A different job, but it's a good job.
Okay.
But we'll talk about it at some other point. But yes, I will You might have missed it because you were in a little bit of a daze yesterday, but I did state that I'll be going back and forth from an undisclosed European location.
No, I know that, but I thought that you were
not Middle Eastern location. No.
Okay, gotcha. That's the one I was curious about.
Yeah, two different roles. Yeah, we could talk about it at a different time. But the thing that I've been looking at and kind of trying to understand is we've removed some capital out of the business, everybody's business, I guess, out of the whole entirety of the industry, and moved it more towards renewables. But at the same time, we're still producing record amounts of oil and gas, even more so than we were producing prior to the pandemic. So in that respect, it's like you've removed capital out of the system. You're actually still increasing in terms of supply onto the markets, and demand is still there as well. But it's just, when you artificially, let's just say prices were to creep up to the $90, $100 range, people would just open up the taps because they're curtailed. And so I don't think, unless there's some sort of geopolitical event like a war on, say, Taiwan, or a greater expansion, unfortunately, of the ongoing wars that we're seeing in Israel and Ukraine, I don't think you're going to see a big spike up, say, over $100. And so I do see that there's, like we kind of have seen over the past few quarters, this bounce back between $70 and $90, for WTI specifically, because that's my area of focus right now. But anyway, that's just kind of my thoughts associated with that. But I do hear what you're saying. I mean, there is always that pressure as we move into the summer months that there's more demand. And
see, the thing is, have you been looking at any of the news about refinery outages lately?
Yeah. Some of them are pertinent to you, Doc.
Yeah. So that's the thing that I'm seeing too. So the fact that we're having refinery outages ahead of time means that oil itself could be well stocked in terms of production. But if you have a bottleneck with refining, that's a bit of a problem, because that will increase costs at the pump, right? So increased costs at the pump means increased costs for logistics. Increased costs for logistics gets passed down to consumers. So that's why you have a bit of a reflation scenario happening. So let's just look at some of the data that people have been looking at. So the first one is just right here with the Cleveland Fed Nowcast, right? I wouldn't say that they're 100% accurate, but they've nailed it pretty consistently over the last year, right? According to them, you're looking at a CPI in March of about about 3.7 almost. And I thought, maybe the data is a little bit weird. It's, maybe it's not necessarily taking a lot of it into consideration, a lot of maybe just short-term volatility moves. But then I also started to see that trueflation, which I don't gauge as official data, but at least gives us a sense of momentum on which direction inflation is headed towards. And I'm seeing, let me just bring that up. Sorry. Trueflation. I'm seeing the same thing happening on that end where, hold on one second. Right here, share screen. Okay, so you see this right here? Mm-hmm. So this looks like a really good chart, except for one thing. When you look at it on a monthly description, according to the data, literally we should have been under 2 in March, but you see that reacceleration happening post that. It's gotten to about 2.2. I think some of this is lagged, but for the most part, a lot of people were looking at the momentum on a downward trajectory, and now you're seeing a trajectory going higher. So according to Trueflation's data, you're starting to see food away from home accelerating, which probably means it's probably related to increases in wages, because we have a tight labor market. But a lot of states went ahead and passed minimum wage increases. So a lot of places are seeing that happen. And then housing has been pretty stable. It hasn't necessarily gone down very much. So right now with the one of the cases that JPowell was trying to make today when it came to the Fed making its decision, it was based on, hold on one second.
Chris is in trouble.
One second. No, it's just, I think he made. Wait, it's getting late in the day. I need your help. You know, this is what happens when you hire someone who, like, I have. It's getting late in the evening, and I need your help. Not too long ago, I have been texting, but I think he may need a rest for what's going on. All right, I might have to leave. Sorry, man.
Yeah, you're good. Just let
Even
me
though
know.
technically I'm not even on shift, but there's a new guy who I'm working. Well, technically he works for me, but good help
You're
is
high
hard to
flyer, man.
find.
Yeah.
Good help is hard to find. But we'll see. Let me dig a
Yeah,
little
you're
bit
good. You're
and
good.
figure out. But the point is, if we're looking at transports right now, we're seeing gas prices starting to accelerate and getting back to, it went from disinflation and deflation, which really helped bring CPI down, to now being back to like a normalized state. So I think car sales in general, like vehicle purchases, I'm starting to see that a lot of inventory is sitting around, so that's helping. But gas prices going higher does not help.
It doesn't
Utilities is
help.
probably
It
fine.
doesn't
Yeah.
help, Chris. But like, if you go back to that, you can still
Hmm.
see, like, on the transport part,
Yeah.
the wavering of it over the past several quarters, right? And so it's come
Right.
up, it's come down, but we've still been on this trajectory downwards. So I mean, you are pointing out some things that might push it or at least flatten it out, and maybe we'll stay in the
Hmm.
mid threes, low threes, and high twos for longer. But I don't think it's going to be rising. I guess my question is back to you, because
Hmm.
I'm just trying to clarify, because I'm not smart, you know that.
Yeah.
I'm not good with math. That I mean, do you think we're going back to the mid threes? Do you think we're going to the high threes, low fours? I mean, what's Mr. Patel kind of
Well,
inkling here? Or are you just saying we're going to stay flatter for longer and not go to 2%?
I mean, according to what I'm seeing, we're looking at mid threes in March. I mean, I can't help but think that the Fed today, the signaling is a little bit off. I don't know if they're calling it wrong, but according to them, rent prices will go down, and eventually that'll catch up, and that their current models are showing that three rates are justified. But I don't know, man. I don't know how the market's going to take it if we get a hot CPI print again. So this is one of those things that it's like, do you want to believe the Fed? Like, is this the transitory narrative coming back again, where they're just like, oh, it's transitory, and then
Mhm.
lo and behold, it's not transitory, right? So I think a lot of time people think that the Fed is immutable, but they're, once again, data driven. This
Yeah,
is
and I
the
think
Texan. Yeah. Sorry, go
um
ahead.
no, I was gonna say, I mean, the thing that bothers me, I think, is, and I've been thinking about this when you mentioned it earlier. Hey, I wanted to chat about this, and it's a good time to chat about, because obviously we have the FOMC today. But my thought process is like, man, it was the Fed was too late to react, and then it's almost like they're almost too late to react again on the opposite side. Too late to start raising rates. Now they're too late to kind of start cutting rates. But at the same time, it's like, I feel like we all know it. It seemed like, I guess, it was going a little bit too smoothly with how quickly it's been going back down. And I think where the Fed probably was right was they were kind of forecasting that it would be probably until like mid 2025 timeframe for them to actually get closer to 2%. And maybe they are onto something. Maybe they got kind of the mid fives to the mid threes wrong in terms of the pace at which it would go, because I feel like we kind of blew through that versus what the Fed predicted kind of when we were at the peak of the cycle in kind of 2022, 2023 timeframe. Was they were kind of forecasting that it would be a lot more longer into 2024, 2025 before we got into the threes. And we kind of blew through that kind of 4 or 5% range back down to the threes. And maybe you're right. Maybe they were accounting for what you're kind of talking about, which is kind of stall period at 3, and then eventually we'll kind of right size ourselves once some lagging effects really start to play out.
Like I
Anyway,
said, the data that the Fed is seeing is different than what we're seeing. So I think what's happening is the Fed is reacting to data that they understand should be materializing 6 months from now, whereas the data that we're seeing in the short term is the other way around, right? So short term, the data says, hey, we're getting reacceleration in inflation. Fed sees long term, no, this is just, I hate to say the word, transitory again, you know. Now, the thing that we have to remember is that things could be in transitory mode, and something can happen on a geopolitical level that messes things up, and now all of a sudden we've got reinflation again, you know. So as an example, you could say, oh, we're transitory, and then the Russian war happened, and it's like, oh, look, we're not actually transitory, we're in real inflation again. The point is, I am going to take the Fed and Jerome Powell for, you know, at their word, and think that they are going to have 3 cuts later this year. I'm hoping that there is some material weakness in labor demand going forward, which, I mean, technically that means that people will be, you know, maybe there just won't be as many job openings. That will eventually cause inflation to come back down below that 2.5%. The one thing that I did notice today is that 2% target is like a moving target. So they're expecting to get to 2% by 2026, 2027, which means that it's not like, hey, we're going to only cut if it gets to 2%. Like, that's a very important thing that
but they backed off of that, though. I feel like
yeah,
they used to be like, if we were talking 4 months ago, I'd be like 2% means 2%. But I think that that's why we've been on such a rally over the past few quarters, or well, I guess it is almost a few quarters now. 2 quarters is since basically late October. Because of that reason, every meeting since then, it was like, holy shit, 2% doesn't mean 2% anymore. 2% means near 2%, or at least on a path towards 2%, which is very different what they were talking about mid 2023. But I did want to point to this. Chris from Data Driven Investing, he always does good research. I really love watching his stuff. So you guys that are on Twitter, be sure to follow him at Data D Investing. He pointed this out. I don't know how factual it is, but yesterday, basically before this meeting, there was a 59% chance of having at least one rate cut by June. And he pulled this up. And now, after today's meeting, this confidence now goes to being about 75% of people believe that there will be a rate cut. Now, keep in mind, this is where we're at. We're at about 5.25 to 5.5 is the current Fed fund rate. So they're talking about some people believe that there's going to be 6.5%, 7% chance that we're going to cut by half a point. So basically down to 4.75 to 5%. And then there's another 70% or so of folks that think we're just going to have one rate cut of about a quarter basis point between now and June timeframe. Chris, I'm curious what your thoughts are based off what you're talking about. I don't even know if this is even valid. And I guess I'm kind of curious as to why things would go in the opposite direction. If 59% of people yesterday were kind of hearing, I don't even know if there's going to be 1 or 2 rate cuts. Now it's up to 75%. I'm curious what your thoughts are based off of what you're seeing with inflation. Do you think it's just the backing off of the Fed? Do you think they say, hey, we're kind of getting on this path where we're kind of too late down the road? We need to get cuts going before it's too late. What are your thoughts about that?
I think the Fed realizes that one of the reasons why they have inflation, especially in shelter, is because they're keeping rates higher. I know that this is really freaking stupid, but the longer they keep rates higher, the less inventory there is in the shelter section. So right now, what you're seeing is people wanting to sell their homes, but they can't necessarily find as many buyers. So a lot of people are not listing their homes, right? So right now, even though it's getting better in terms of inventory coming to market, it still hasn't returned to normal levels yet. So when it comes to housing, it's not only based on demand, but also on supply. So right now, what you're seeing is a lot of people that have sub-3 mortgages, they're not going to up and leave. They're going to stay in that sub-3 mortgage, you know? So what we're seeing right now is a little bit weird in that by keeping rates higher, normally with higher interest rates, you would see people like scaling back on buying and the price of homes coming down. And that is happening, but not to the level that we need it to happen in order to get shelter inflation much lower. So what the Fed is trying to do is say, look, we are definitely going to be cutting in the future. So if they start to cut in the future and they get down to something like 5 on like the 30-year fixed, I think a lot of those people that are sitting on 3% mortgages, they might just say, hey, you know what? I need to move because my job has been relocated, in like 20 miles in another direction. I'll give you an example. My brother-in-law and my sister-in-law, one's a doctor, one's a lawyer. They have a really nice home. They have a 3% mortgage. But the thing is, my sister-in-law now got a new job working, in the opposite direction of where they live. And now she's driving about an hour and 20 minutes each way. They want to move, but they also don't want to sacrifice that 3% mortgage to inherit a 7% mortgage, right? So what happens? Now, the thing is, it's such a big price difference that the thought is, hey, maybe I'll just stick it out, But if if let's say the mortgage goes to 5, that's a lot more acceptable. They're like, yeah, whatever, I can deal with the 5 and I could just sell this one and then buy a new one. Because remember, the problem with transactions when it comes to real estate is that if you have a 3 and you have to go to a 7, you're going to say, hell no, I'm pretty much doubling my mortgage. It's not worth it. But if you're only going about 200 basis points a little bit higher, that means that now there's going to be probably more people that can afford your home, which means that the price won't go down as much. But then at the same time, you're actually going to be able to afford your next home, So it's kind of a weird situation that we have with housing. So I think as the Fed lowers interest rates, more shelter is going to come on the market. And if more shelter comes on the market, the price of shelter should theoretically, based on supply and demand, come down, but they have to do it in a way that makes sense, So we'll see what happens, but as of right now, I still think the shelter is a little bit tight. It's not to the same levels that we had in 2019. So until we get more inventory to come in, it's going to remain tight, which means the asset prices are going to remain elevated,
So to give people a flavor as to what Chris is talking about, I'm just looking at a $350,000 house, for example, and I'm just looking at what is it in terms of a mortgage only, not talking about taxes and all that stuff, but let's just say mortgage to mortgage. If you were to put down, let's just say 15%, and you were to have a 7% APR, your mortgage is going to be close to $2,100 a month. If you were to now have 7.625 or 7.5, let's just say a half a percentage point, it looks like it goes up about $120 a month, right? Just based off of that half percentage point. I think if you do it in the opposite direction, 6.5% comparatively to this 7%. Let me just do it right here because I have my little calculator. It ends up dropping it. What is that? About $130. So if you go from 7% to 6.5%, it's $130. So start thinking. I mean, then if you, let's just say, for example, we go to 5.5%, it's $1,750. So you went from, let's just say, the 7%, which was just over $2,050 just on mortgage alone, to now 5.5%. So it's a cut of 1.5%. You're talking about, $250 to $300 a month. And so that allows, there's like this middle ground of people being able to kind of like move and be mobile. But I guess my question is like, what is too much? I mean, because I think what you're going to end up seeing is almost like this dichotomy, because there has been, I see what you're saying, Chris, but I feel like it's a fine line. Like there's almost like if it comes down to the low 6s, I feel like I see what you're saying. But if it comes down back into like the mid to low 5s in terms of a 30-year interest fixed rate mortgage, I feel like you're going to be in this other scenario where you've had wages increase pretty dramatically over the past few years. People have actually gotten some pretty decent raises. So wages have actually come forward and up a little bit. And then you couple that now with this decrease of mortgage payments by 20 to 25%. I feel like there's a fine line between what you're saying, which is freeing up people from these 3% mortgage rates and allows them to actually be mobile and move and not have to double their mortgage, because a 3% versus 7% at the same price point is, like you stated, going to be over $1,000 a month in difference. Now, the opposite effect kind of happens where you get kind of in that middle ground. I don't know. I see what you're saying, but I feel like it's going to be a fine line depending on where rates actually end up. I don't know, just some thoughts. I know you're working in the background, but I guess my question is, let me unless you want to further discuss that, I could always pull up the portfolio. You're on mute, my guy.
The one thing I will say is that I think now is a good time to buy a lot of secure stuff that can basically, how do I say it? Basically, now is the time to look at the capital structure of a lot of companies and basically take some prudent steps in allocating capital towards those capital structures that give you a equity like return with the guarantee and safety of a credit instrument. I know that sounds off, but basically it means bonds and preferred equity.
Yeah.
You know, so
Think,
right
for
now,
example,
yeah.
if you were to able to find something that's say trading at a discount
Hmm.
on the open market, that let's just say was kind of struggling, whether it was a commercial real estate company or something like that, and their bonds were trading at 50 cents on the dollar. Basically, you're saying with potential rate cuts coming into play in the second half of this year, it might be prudent to look into those because it might not go back to par value, but it'll at least loosen the collar a little bit where people will actually potentially play ball, and maybe it'll increase from 50 cents on the dollar to 60 cents or 70 cents. But even still, if you're starting at 50 cents and you're going to 60 or 70, that's a 20 to 40% return on your capital. And while you're getting paid that excess, let's just say coupon rate, because you're basically buying twice as much bonds for that price because you're buying it 50% off. So I see what you're saying with that.
Hmm. Yeah, I mean, there's a lot of sectors right now that have been pummeled over the last couple of years because of how fast the Fed has raised their interest rates. So when they start cutting, a lot of them also have the ability to generate cash flows and be able to be a lot more secure. Do I think that it's going to be a while before they get back to par again? Yeah, absolutely. But right now the goal is safety. We've had amazing gains over the hey dear, we've had amazing gains over the last probably 2 years. I'm talking about like triple digit gains. One of the things that I like doing when I have these really, really good years is just like a squirrel, take some of it and put the nuts away into the tree, and then just have that like be the income generator for a while. So just in case we do get a little bit of a pullback, we've got some cash flow still coming in. So,
Yeah. Good
yeah.
thought. BC, much appreciated, my man. $9.99 as always. You're coming in every day. Yesterday, I think, was probably the best return day that we've ever gotten for the stream. So that was awesome, and a lot of that was attributed to we got Uncle TJ joining us. We got a lot of people.
Hey,
in the chat.
TJ.
Over 100 people in the chat at this point, almost 151, Chris. So it's kudos to all your knowledge with respect to what we think is going to happen going forward. So we didn't have the opportunity to look at this yesterday, which is the public portfolio. We're closing in on the end of March-ish is kind of coming up here, so we'll probably add another $100-$150 here.
Do you have a view of the chart with like the total return by any chance?
I saw it earlier. I will double check. Maybe I'll take a screenshot and share it with you, but I'm just afraid of pulling something up and sharing account numbers and
Gotcha.
like that. Yeah. So the last thing I want is that. But I should have done this by total return, but obviously Celsius is our best. We're almost up $300 just on what is it, a $430 investment. So we've almost gone up 70% alone on that investment. So kudos to you, sir. 68%. That is now our number one, ahead of TQQQ in terms of total percentage return. And then what else we got there? Dutch Bros is up 28%. Next is up 13%. That's been on a little bit of a jog lately, which upsets me because I didn't tell you this, or I think I told you this yesterday. I put an offer in today on the house. I'm literally just sitting there, and I'm just like, tell me quick as possible so I could buy this damn. Anyway, I think NEXT will come back a little bit, but It's too far out.
I have a question. I have a question for you. How
Yeah.
are you going to manage the beach house if you're traveling all over Europe for work?
That's not my problem. It's my sister's problem. That's who I'm buying this from.
Ah, gotcha.
Yeah,
Okay,
yeah.
that makes sense. I thought you were buying it for yourself to try to. Yeah, I was
No,
like,
no.
okay.
Just
Yeah,
like the other
makes
one,
sense.
I like told my buddy that I bought it with.
Mhm,
We split it, and I was just like, I live in Texas, right? Like you're
mhm.
the one that lives 2 hours away. And he's like,
Yeah,
yeah. He's like, I know. But we also have some good folks. Like we have somebody that comes to do the hot tub every week. We have somebody that mows
nice.
the lawn. We found a good carpenter down there that's done some good work for us. And we also have our friend is a plumber actually, and he has a beach house down there
So
as
you have a
well.
network. You have a
Yeah,
network of
yeah,
people. That's
yeah.
good.
So
Yeah, yeah.
very rarely do we actually have to go down. And my buddy goes down
Yeah.
because one, he lives pretty close, and on an off weekend, he'll go down. And I'm
Mhm,
actually going there next week, just to hang out. It'll be the first time I actually sleep in the damn thing. I've owned it
mhm.
for almost 18 months at this point, which is pretty funny. So I haven't even spent a night in it. I've just been in it twice. Once to look at it before we bought it, and then the day we closed on the house. Oh, I guess you could say 3 times because we did a walkthrough before, um, but yeah, I mean it's pretty funny. I haven't even spent a night, and I've had probably hundreds of people since I bought it. Sleep in and out of the house, which is actually pretty crazy. But this one's closer to the beach, so it'll be fun. We got some super chats in here. Thank you so much, Alan, and also Dreaming Big. Much appreciated. This all goes back into this portfolio. Everything that you guys see is going into this portfolio
Mhm.
for me and Hot Chris. So, Mr. Patel, there's a few other ones: BPYPM, Rocket Lab, which we could talk a little bit about in the second half of the stream. Snowflake, Tell Z. Anything that you want to highlight?
Well, tell Z. I don't know if you saw this news that came out,
Yep.
but Tellurian admits the sale is now possible. They hired Lazard to probably do some. But basically they're trying to sell their upstream assets only. Maybe I have to look into it a little bit further. It's been off
Well,
my radar for a little bit.
the upstream assets were on the table. I think the big thing that everyone's kind of upset about now
Mhm.
is that because I think what people were excited about because the stock actually rallied about a month ago, not really
Yeah.
rallied too much, but it was like 10-15%, which was a lot for maybe the people that bought in the 50s and 60s cent range. Um, People were excited because it was strictly upstream. Now the second CEO within 2 months has now stepped down, and now they're expanding. I think to sell the entire
Mhm.
Driftwood project as a whole. So I think that
Yeah.
that's probably why it's kind of hemorrhaging a little bit of cash. But if that's the case, I mean, doesn't that bode well for the Telz opportunity?
Yeah, it does. That's the whole
Yeah.
point. That it doesn't make sense that why the bond would sell off, but that's how the market works sometimes. It's not traded as often, but once again, it's one of our speculative plays, but if it works out, it'll double our money in the thing. So not double,
That
actually more
was
than double.
Yeah,
Yeah.
that was the play. I mean, I think let me just double check. I have it up here still. So we bought it at 11.48. Yeah. So if
Yeah.
they were to have to buy us out, they would have to buy us out at $25. And in the
Yep.
meantime, we've been collecting a dividend. I think we've only gotten one so far, but we should be on the hook here pretty
Yeah.
soon for another one. So
Yep. Yep.
uh,
Yep. Same thing with Celsius, not Celsius, with BPYPM. I think that comes in at the end of this month in a few days. So
yeah.
that dividend will come in. I think we probably got the Verizon one, so that's fine.
Yeah, I'll double check in the background. Every time
Yeah,
we do get one, I put it into NEXT. It's why we only have $17 in it. But
yeah, yeah,
we'll get there. Hopefully by the end of the year, we'll have a couple $100. But anything in
yeah.
here, Chris? I mean, we're up 24%. We're beating the market. Is there anything that you want to trim, move, add to? We only have $100 to add. We've added more capital to BPYPM. We're up to 40 shares there.
Let's see. If I'm trying to do total return, I think we sell. You know what? I think everything we have is pretty good for the most part. I don't think there's any real downers that we have. Snowflake is still
And it
very
does.
undervalued for its growth. Yeah. I think we just focus on building out positions in BPYPM. Just keep that going. I think that'll be a nice little income stream. Plus, it's still very undervalued. There is another preferred that's in the same category that might be worth adding as well. But I'll talk to you about it privately about it, because one of the things I don't
not
want
BPYPM or a different version, or
I'll explain it to you later. The last thing I want is people bidding this thing up and then literally just giving us a credit. Because the thing is, a lot of these have really low volume. So what happens is even a small amount of money that goes in means that it can move markets higher. So probably not gonna put there.
Yeah, the spread on these things is actually pretty crazy, because I actually looked at BPYPM the other day, and it was like the ask was like $13.51, and the bid was $13.59. It's like 8 cents. It's like pretty crazy in that respect. But
yeah.
What else was there? So Rocket Lab. How much have I talked to you about Rocket Lab? And I know you kind of been like,
I told you I'm not a Rocket Lab guy, man. I
get it.
It's hard to the hardest part for me when it comes to investing in some of these things is that there's no way I can value it against something. You know, like it's like buying a house in the middle of nowhere. You don't know what you're buying, basically, because there's nothing to comp it against. Whereas if you buy something in a neighborhood that has other houses that are similar, it's like, yeah, okay, this house is, you know, it's valued correctly, or it's undervalued, or it's overvalued. But if it's in the middle of nowhere, it could be the best thing in the world, or it could be completely horseshit. So that's the thing that comes to me when it. I mean, I do have to say that I'm glad to see that you are enthusiastic about this company and all the future prospects of it. It's just, for me, it doesn't fit into my realm. I'd rather put my money in the baskets like, I don't know, like Accelera and Next Decade when it comes to being on the spec side of things. But you know, I don't know about Rocket Lab. And the thing is, like, I just don't have the latitude to add more to my research pile than, because I mean, that's the thing. Like, when you find sectors and companies, like, think about all the sectors that I am focused in. I've got energy drinks. I've got commercial real estate. I've got coffee franchises. You know what I mean? It's like,
no, I hear you 100%.
You know,
you kind of have to.
We got some oil, natural gas. We've got software on one hand, like enterprise software. So it's hard to just keep so many sectors in
but I don't want anyone to drag you, right? And I don't think anyone will. I think I don't think you're a hater. I think you're 100% right in way that you explained it. You are literally looking at a sector which most companies go to zero, and there's one that has gone to 200 billion in terms of market cap that's privately held, right? So it's like exactly what you stated. You are looking at a bunch of companies that are Detroit post 2008, right? Like nobody wants to buy. And let's just say LA, that every house sells for over $2 million. And you're like, why is everything selling for $2 million? If you go to a different part of the country, it would sell for 550,000. Like, so I 100% understand where you're kind of coming from. I think the problem is like the way that I think a lot of people approach this is, it's like, I get what you're saying to an extent with respect to the bid and ask price of, say, space in this particular thing is 0 to 200 billion. To me, it's almost like kind of like what you're talking about with Next Decade. It's like you see what the opportunity is of something that's likely to work, and it has the opportunity to say go to 200 billion because that's kind of like the ceiling at the moment. And you're now, if you look at the price, is 1.9 billion. So if you think about it in that respect, let's just say, like, in the 1% chance that this happens, it goes from 2 billion to 200 billion, just like SpaceX does. And it would take a while. I'm not saying tomorrow, but it's just like, well, isn't that worth, to me, you know, look at the speculation piece and also the conviction and work and due diligence that I've done. It's kind of like, I'll put $30,000-$40,000 on that. What's the worst that happens? I lose $30,000-$40,000. I think you know my situation. I wouldn't.
You're good. You're good.
So it'd be like, okay, and it's one of those things. Kind of, I was telling my buddy about this earlier. Same thing with the beach house. I was like, do I have enough money to put down 20% on a beach house right now? I was like, not really. I could find the money. Do I really want to find the money? I don't know. But if I walk by that fucking thing in 10 years and I didn't put an offer in and it's worth $2 million or something like that because it's right by the beach and you can literally see the fucking water from the windows out front of the house, I'm going to kick myself in the ass. Am I going to lose out because somebody comes all cash? Probably. But at least I tried, right? And that's kind of the thought process I have with this. Is like, you have an opportunity and it's successful. Tonight will be its 46th successful launch. It's got 2 launch pads, one in New Zealand, one in Virginia. They're getting contracts with the Department of Defense, Space Force, NASA. You know, you have all these opportunities.
It's legitimacy. There is a lot of legitimacy behind it.
Yes, there's a lot of legitimacy behind it, and there's a lot more players falling out of the race because they can't keep up. These guys have decent amount of capital compared to, say, some of the other companies that are still out there. They did a decent capital raise from a point of strength, not from a point of weakness. They weren't at their last dollar. They still had a couple $100 million left. They said, let's do a small convertible note. The same sort of thing that SoFi noted today when they went on Mad Money. So it's interesting. A lot of people don't understand. There's only 3 space solar companies. This is one of them. They've acquired this in 2021. They have a lot of different satellite projects. Like, a lot of people are like, oh, but it's launch. It's launch. It's actually pretty interesting. I want to show. There's a lot that I can go into this presentation. But I think the thing that intrigues me the most is a lot of people just think that this company is launch specific. And crap, it doesn't have it in here. But it's like they anticipate 2/3 of their revenue to really come from the space systems business. And they kind of are coming out with, and I think this is kind of prudent, these are all successfully tested satellites. So it's like, if you're looking for, and obviously they're named for a reason, right? Explorer, Pioneer, Photon, Lightning, they all have their specific sort of reasons why they are building a specific satellite. They're shaped differently, they do different things, etc. You can see this is very solar intensive. You can see this is like a lab test for space, which they just tested, and the results came out for the Varda, which was kind of like a space test lab, which could be used for chips. It could be used for pharmaceutical testing, etc. You can do a lot of these different things, and it's interesting because they've now created all 4 of these, and it's going to be off the shelf. So it's an interesting space. I mean, I could go off for a couple hours, and I have on the channel. You could kind of see the size of this new vehicle that they're coming out with. But anyway, it's kind of just, in this respect, I think a lot of people don't necessarily understand the vastness of what's going on.
I'm just looking at it from just purely like number standpoint.
Yeah.
The biggest concern that I have about this company as of right now is the cash. Yeah. They have $250 million in cash, but their cash burn rate is pretty substantial. So that's the problem that I'm seeing in terms of operating cash flow. They're burning about 40 billion right now, but I mean, they've had periods where they've gone down a little bit and they've gone up, but on a trailing basis, well, they've got about 2 years worth of runway.
Yeah,
right.
And
before they start capping.
They just got another 300 million in the first quarter, so that's not showing up in the numbers you're looking at.
Wait, 300 million from where? From what?
From a convertible debt offering, and then they wrote a capped call. So it will dilute shareholders 5-6% or something like that. But if you think about it, it's $300 million. That gives them a lot more runway. And the second thing I want to note here, Chris, I understand where you're coming from with respect to, and kind of to maybe make the numbers make a little bit more sense. Is it on here? Yeah. So give me a second to explain before you dive into the numbers here. They've been working on a medium launch vehicle. So they're designing a rocket that's going to be competing in the same space slightly smaller, but comparable to the Falcon 9. Right now, their launch vehicle is very small. It can only launch like 600, 700 pounds into lower Earth orbit. This other rocket is going to be able to launch 15 tons into orbit. So something much different in magnitude. So with respect to that, they're putting a couple $100 million into this, which is part of the burn rate. And if you look at specifically their profitability trends, they're going in the right direction, right? And once you get over this point of CapEx associated with investing in this medium launch vehicle, and as well as revenues increasing by double this year, you start to understand that they're going to get to a place where they're obviously EBITDA negative right now, but you'll get to a place where you're kind of EBITDA positive, and hopefully, once you get over the hump of investing in this vehicle, which is going to cost them 200 to 250 million, all said and done, and another $100 million this year, I assume. That'll happen hopefully by the end of this year is what they're forecasting. But mid next year is when they're kind of saying, all right, well, we're kind of done with this major investment. Hopefully it's successful. They've obviously demonstrated that they've been able to be successfully launching this vehicle since 2017, 2018 time period. They've obviously had smaller versions, etc. But this one is actually commercial based, and it's been working since 2017, 2018. Now let's add this second one. $50 million a launch is what it's going to cost somebody to run that, but they're hoping it's going to, for the actual margin, they're going to hope it's going to be 40, 50%. So they're hoping it's only going to cost the company 25 million. So you start thinking about that. The revenue is going to go through the roof. Their margins are already at 32% on an adjusted basis. If you do net gross margin, it's 26%. So you're going from $240 million in revenue last year, 2023, to hopefully closer to 400 this year. So you're increasing adjusted EBITDA, hopefully for the year, to closer towards positive. But then it's obviously offset by the fact that you have all this CapEx associated with their secondary vehicle. Going to next year, the hope is you get closer and closer to the point where you're actually EBITDA break even and actually generating a profit. And if that's the case, that's pretty impressive. And next year, I think the revenue is expected to be closer to 600 million. So within 2 years, you're supposed to get probably an increase of 80% in terms of revenue. But we'll see. This year is a building year. Going from 240 to 400 million, that's a pretty big ask, right? So it's almost I didn't mean 80%. I meant 150% from 2023 to 2025. If we get to 600 million next year, it'll be a big ask, right? And if they're able to accomplish that, it'll be impressive. They launched 10 rockets last year. They're hopefully on pace to launch 22 this year. This will be their fourth launch for the year. They have a couple slated for next quarter. So you're not wrong, right? But I think where I'm getting to is the runway for the capital exposure to be so poor, where you're like, this company's going belly up, is shrinking by every single time they launch a vehicle. Yeah. And yes, it is a gamble, but with where they're at, I would say, and I say this online, my thought process is bankruptcy is near zero, but I say this online just to save face, because if ever does, because I'm also an optimist. So I think that in reality, if I take off my kind of like optimism hat, if you had asked me 6 months ago, I would have said, chance of bankruptcy is probably 10 to 15%. I think that chance to bankruptcy is closing in on 5%, if not less than 5%.
Yeah.
Because
interesting. Yeah.
Who else is? All these other companies. Astra is closed up shop. They don't have anything. They used to be $1 billion company. Now they're literally got sold for less than $100 million. Virgin Orbit's out of business. These guys bought up a lot of Virgin Orbit assets for 16 cents on the dollar, literally, because they bought it for 16 million. They got probably like $100 million worth of lease space and equipment and God knows what else. I mean, it's interesting. There's still a lot of things on the table as well with respect to they've signed a lot of deals to create satellites, like the Space Force one, the SDA contract, 18 satellites that they decided basically the government decided that yes, you guys will be the prime contractor for that. They haven't decided who's going to launch those satellites into space. Well, obviously, if you have to launch all those satellites into space, it's going to cost a pretty penny. So there's the opportunity to win that contract as well. And it's not to say that that contract, which was a $500 million contract, is the last contract of its kind. They're going to launch up the Space Development Agency, which is a subset of the Space Force, is going to launch up thousands of these. It's literally like a defense layer. Like if you look at it, and this is where I'll stop, because obviously your brain is already kind of full, but like this is literally just, if you think about it, like a huge network that's supposed to be around the Earth on a day-to-day basis. So there's going to be literally hundreds, if not thousands, of these satellites. So who's to say that they're not going to win the 5th tranche, the 7th tranche, the 8th tranche? Now, if you're already a prime contractor and the list of people that can provide this sort of satellite is shrinking by the day because it is such an intensive business, and these guys are, the most well capitalized, other than say SpaceX and maybe Jeff Bezos because he's a billionaire, and then Northrop Grumman and Boeing's
ULA, right?
Yeah, then you're kind of in a list of 4 people that can provide something like this.
Yeah, I think European Space Agency launches, JAXA launches, India launches. I mean, so there are multiple players, but it's not as clear cut, in my opinion, as to where the total return is going to be. But I mean, especially with the U.S. government, they're not going to subcontract to like the Europeans or to India or Russia or anyone else. They'll be launching with either SpaceX or Rocket Lab. The only thing is, I still think that this is a little bit too early for me. I'd probably give it about a year or 2 before I really get interested. Yeah, I mean, like I said, it's on my radar, but I just have so much already on the plate that it doesn't. The other thing is, like, I'm not going to have, I don't want to sound negative, but it doesn't interest me as much as it interests me.
I get it.
So
I get it.
When it comes down to it,
I hear you.
Yeah.
There is still risk, right? And I get that. And if anything,
it's not just about risk, it's about interest too. Like, you know what I mean? Someone came to me the other day and said, "Hey, there's this really great company that does X." And I'm just like, I'm not interested in that industry. So even if I looked at it, I wouldn't give it enough attention, and I wouldn't have I wouldn't have any conviction in it. So right now, I think
it's funny though. Like I get it where you're coming from. It's just like you don't have that like underlying, but it's like at the same time, it's like a drink company and like a shoe company gets you fired up. But I get it, right? Because I get fired up by Dutch Bros. I get fired up by Celsius. I drink at Celsius. I didn't tell you this yet. Maybe you saw it in the Celsius chat in the Discord. I tried that dragon fruit, probably why I'm speaking a mile a minute, or at least I feel like I am. I drank it when I got home because they just shipped it to me. I put it in the fridge, let it cool down for a couple hours. It's fucking fantastic. It's
really
fantastic. Yeah, the dragon fruit. They're not called Heat anymore. They're called Essential. I tried looking for Heat on Amazon. They don't have. They used to have 5 flavors, and they went from 3 to 4 to 5 flavors of the Heat, and now the Heat is gone. Now they're Essential, and they changed the design. So I'm not sure what the underlying marketing technique was for that, but
I think it's just a category. It's both. No,
you think they have both now?
Yeah, they have both. It's not. They didn't replace it. They just one just I think has even more caffeine than the other one. I think.
Okay.
Well, yeah. Let's see. Let's take a look. The thing is just a different SKU. Yeah, it's still all products. Let's just take a look. So this is the original, just the regular Celsius, and then they have the flavor packets.
Have you tried the packets?
I have not. I don't even know where they are. Then they have
them.
this right here is the essentials, right?
Yeah.
And let me see, Celsius Heat. Is that discontinued? This right here, right?
Yeah.
Maybe they did discontinue. I don't see it on their website anymore.
Yeah, because when I went to Amazon, they only had the jackfruit, which was I've had it. It's not bad, but yeah, and then they had this one. But other
Yeah,
than
they've
that,
got
it was
orange sickle. My wife got me an orange sickle. I wasn't a big
the
fan.
really? I like it.
Yeah,
I like it.
I have to try
Yeah.
mango tango. But you're
I
saying
always try
jackfruit
that.
is really good?
No, I don't like jackfruit. I mean, it's not bad. I wasn't intrigued
Wait, which one
by it.
did you have today? That you said that
I
was really good?
had the essential dragon fruit, but I've had the cherry
Oh,
lime heat.
dragon fruit.
The
Yeah,
cherry lime heat on ice is
yeah,
phenomenal. The peach, I don't know if it's peach mango, the one that you told me to put on over ice that tastes like
yeah,
a really good orange juice.
yeah.
That's phenomenal.
Mm-hmm.
Yeah.
Celsius. Okay, let's see. My favorite so far has been this right here, which is the fruit punch, the Celsius. I this and the vibe, the cosmic vibe. That's been
Cosmic
like
Five.
this one is probably my favorite. I just had this one today, which was really good too. Which is probably why I have enough energy to do this podcast. But yeah.
All right.
Ugh.
Well, I'll have to try that. But I love this comment. From space launch to peach mango in less than a minute. Only on Cashflow Chronicles.
Yeah,
But
but we're
I
making
appreciate and
money. We're making money.
I will say, Chris, I do appreciate somebody that just doesn't like give in. I like the fact that you're like, look, it's too early. And for those people that are listening, you're like, man, Matt's maybe making a point, right? I'm not as down in the company because like it's not into me like Chris, but I kind of see where Matt is. If you're somebody that doesn't like to lose money and you're like, I would like to invest in this company, but you're like, I still see the potential risk. It's space, it's expensive, blah, 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 blah. Literally within a year, you could let a lot of these things and risks and cash burn transpire, and you'll have an open book to be like, okay, they were successful in this medium rocket launch. They burned X amount of cash. They are X closer to profitability. And I would say maybe the stock price will be $8 to $10. So maybe you lose out on a double. But at that point, it's still only a $4 to $5 billion company, and you have that other, let's say, $100 billion to potentially play with. I don't think if this were to go, I don't think it would stop at 5 billion. I think it would stop at closer to 15 to 20 billion is where I'm like very confident it'll go to. Is it going to go to 200? I think that, SpaceX, they're at a much greater cadence. It's going to take literally a decade to find out if these guys are anywhere close to where SpaceX is. These guys are 5 to 8 years behind when it comes to launches and everything like that, and even more because you think about it. SpaceX has been launching the Falcon 9 since what, 20? When these guys basically started getting their Electron started, it's when SpaceX was starting to land their vehicles. So they're, 8 years behind when it comes to that. So, so anyway, so just some food for thought. So I'm very confident that it'll be a second to SpaceX. But I understand where Chris is coming from. It's worth sometimes to wait a year. Like, for example, Palantir, it was worth to wait a year to be like, okay, they're adjusted EBITDA positive, but are they actually going to get to net EBITDA, like gap EBITDA positive? Because you can play around with some of these numbers, share-based compensation, etc. And that whole year to 2 years while you're effing around waiting, like I was with Palantir, you could have invested in other companies and made money on those other companies and picked up Palantir when it started to truly get to a place where it was net income positive and still done just as well as I did. Right. This could literally be the same in happenstance where I've rid this down from $10 to $4 and I've bought shares in the high threes and I've just been sitting on my hands for the past 2 years. You could come in a year's time and pretty much only lose out on, a fraction of the total potential long-term gains. But anyway. Yeah. All right, Mr. Patel.
Are you looking at any other sectors right now besides the ones that we already have?
Bitcoin, which I know you're not really into. I actually thought about, which I wish I took. I was looking at, there's only one Bitcoin ETF that you can write options on that I've seen so far.
MSTR, right? Well, technically it's not an ETF, but
no, there's actually one spot ETF that you can write options on. And I was thinking about doing a spread. I think it's the ProShares Bitcoin.
I have a friend who bought a crap ton of MSTR calls, bro. He is done. He's like, he texted me, he's like, bro, I am done. Like he's in the 8-figure mark at this point. Wow. I'm like, congratulations, brother. That's the way, man.
That's where I'm trying to get to within 8 years. Is that mark?
Yeah. He'll be at 8 figures, and you know what's really cool? This dude, he put it all in his retirement account, which means all of it is freaking tax-free. So I'm like, congratulations. If you just put that same that same amount of money that you have now, and you just put it into like the S&P 500 and bro, that's generational wealth that's sitting in a tax-deferred account. Yeah, you fucking believe that shit?
That's where I'm at. To be very frank, like I always, I don't like to discuss too much about my where I'm at, but it's like, I never thought I'd get to where I got to. I like set a pretty ambitious goal and I missed it by a year, which is still pretty impressive on its own right. But like the fact that I'm even thinking that I can actually achieve getting to 8 figures is something that like I always wondered if I could do when I was younger. But anyway, it's pretty interesting. So to hear that others are doing it, and especially had I played my cards right with some of the things that you had shared with me, SLG, which I agreed with 100%, Celsius, which you and I have been covering since like August of last year, since we pretty much started Cashflow Chronicles. It's just we never really had enough data at the moment and I guess conviction until earlier this year, obviously when it dipped back from like the mid 60s to, because we were covering it before it even split, and then it split, and then it jumped from like the mid 60s post split down to the low 50s, and I'm like, I don't know, man. And then you were like, let's do it, and I was like, okay, if Chris is on board, then I'm obviously so anyway, it took
a lot of due diligence, though, be honest. Like, it's not easy for me to get conviction in a new sector that I don't understand. It really took me, like, you see, if you go back to Twitter, you can see all the stuff that I was doing. Like, I don't know if you guys know this, but you can ask my wife because it probably annoyed her a little bit. But every time we would go to like a Kroger, a Publix, or whatever, I would like strike up conversation with people and be like, hey, have you heard of Celsius? Like, are they selling? Like, are you doing, like these are like on the ground due diligence points that you don't get to make without doing that. So I'd go to like a random place and be like, okay, do they have Celsius here? Let me find out. Let me see what it is. I would take random pictures. Like people were telling me I had like Jeremy / tattooed chef vibes, when it was really bad. I was like, so, dude, I'm not gonna lie. To some degree, I started to feel the same exact way too. I was like, am I really doing that? Like, is this gonna be my tattooed chef moment, right? So you see this all the way in May 2003. I was going around and I was actually taking pictures. Like, look, Celsius is sold out, And I was like, what does this mean? So a lot of people were like, oh, where is it? It's funny. Where is it? Someone said, I don't know, it's somewhere, but basically everyone's like, tastes like dog water, which is great, also 22% short interest. Let's see. But it's very interesting to see like some of the comments, damn it, where the hell did it go? All right. Well, someone said that it was going to be my tattooed chef moment, so let's see if I find
the first one that I have is November, but let me pull up our content from my channel live.
When did I start? Okay, so this is when I started researching. No, that's February. Let me just go to the latest and then go all the way back. See what I mean? Now everyone is doing it, trying to figure out. I love this guy. I don't know who he is.
Nuevos máximos para los Celsius, puñeta.
I love that. Oh my god, this guy's the fucking man.
Yeah, but what's interesting about this dude is that he's got $1 million position now. He
Does it?
like if you, bro, he made money. Let me tell you.
Good
Like,
for him, man.
You think I made money? He made money. So let's see.
Did he? Well, how much did he buy stock? Did he buy put like options?
I don't know. He just showed a clip of his like not total return, but his portfolio.
Him,
so yeah.
No, the earliest I have, you have it from May. The earliest I have is from like November-ish time frame. We did a couple clips in November, but I feel like we did more on Cashflow Chronicles way earlier. But maybe I just didn't tag it. But either way, interesting. Yeah,
it's very interesting. I'm telling you, people really like. There's a lot of crowdsourcing data that you can rely on that gives you a good insight that like maybe Wall Street misses out on a little bit, you know? So it's one of those things. Like this is why you have to, and dude, it was more Peter Lynch play than anything, where it's like, yes, the financials are trending in the right direction, but more importantly, you could see the product everywhere being sold.
Yeah.
And you could see the brand presence everywhere. And so that's what really drew
that's the thing. It's not slowing down, Chris. It's still growing, which is like, I remember when Monster came out and people were freaking out, but like, dude, like maybe it's just because I have my eye on it right now, but it just seems like the first quarter has been insane. I wouldn't be surprised if you see a jump 30% just in the first quarter, because it's in terms of sales, right? It's just been absolutely insane. The amount of advertising I've seen, the amount of ramp up I've seen of additional places holding it. It's pretty insane. But there's a place, if I ever want to try a flavor before I buy it, they literally have every flavor. Like I had lemon lime for the first time every day. The other day, it was great. If I ever want to try a different flavor, I go there.
So someone made a comment, Matt, you have to realize Chris prioritizes stocks where big gains can happen within a year. That's not true. I have positions that are like moonshot positions. It's just like next decade, I know it's not going to skyrocket within a year. Abceller, I've been holding it since like 2001 when it IP, well, not 2001, when it was like, and I'm actually down on it.
2021, you mean?
Yeah. But so it's just, I have both the ends covered, where majority of my money is in plays that can materialize. Like, I think, did we mention how I structure my portfolio, where 50% is usually allocated towards like rapid growth? It's going to do exceptionally well within a year or two. And then you have like the medium term and then the long-term portfolio, right? And basically that's how I structure it. So you've got a long-term, medium term, and short term. So it is what it is.
Yeah. I mean, I don't think you're wrong. You and I talk about just putting money. I mean, you guys don't know what Chris has right now. He has something that is very much a, cash flow sort of position that he's doing very well on right now. And you guys would be surprised. You'd be like, oh, he's doing spreads. He's doing this. Why does everyone think? I don't understand why people think you're like this gambler, like spec, like very quick. And it's like some of the plays take a long time to see out and develop that you're kind of coming up with. So I don't think people are giving you enough credit. Maybe it's just because I only cover 3 different positions and I hold them for a lot longer, and I'm willing to go into the red before I see any sort of light of day at the end of the tunnel. I need to get better about that. I need to get better. I need to be more like, and I've thought about that. There's SoFi was one. SoFi was like, I don't know if I want to take on another position, but now it's profitable. And I'm like, that's probably a good place to store capital. Is it my favorite? Probably not, because to me, I'm with you. I'm more on the lens of it's just a bank. Like I could see it getting to being worth 20 or 30 billion, but do I think it's going to be the next JP Morgan? No, JP Morgan's a 400 billion, $500 billion company. Like it's not going to be the next JP Morgan. And if it is, it's going to be forever down the road. So to think that it's going to go from $8 billion to a $5 billion market cap within that, a time, there's so much competition. And yeah, they're climbing the ranks. They're in the top 100 in terms of assets under management, but that's the thing. Top 100 of assets under management. There's a lot of other banks out there that are doing the same thing. And had the thing that I liked about where SoFi was going, it seemed like they were going to make an application that was going to bring, the true financial institution business from the 90s to the 2020s. And it's like they've kind of stalled a little bit, in my opinion. Maybe I just haven't done enough due diligence, and I'm going to get dragged by Tevis and Roy and many of the others, and that's okay. It's my ignorance, and I'll admit that. But I have my 2,300 shares or whatever SoFi, and right now it's a stack of capital. If I could find a better place to put that money, that I could guarantee I'd be able to get a win in, which I've honestly thought, in the past couple of weeks, maybe I should have sell it and add to RKLB. I might. It's to me, it's a place where it was better than staying in Pepsi. I like Pepsi. Pepsi is a great dividend company. But right now, if I just want to sit and have guaranteed growth and a dividend, I'll put it in SPY. Why would I have it in Pepsi? Pepsi's not going to double. I see SPY doubling within the next 6 years or so. And a lot of that actually, probably I should adjust that, because I see SPY going to 9,000 by 2030, 2032. So I guess it won't double anymore because it's run up so much. But anyway, Mr. Patel, thank you, sir. I much appreciate your time tonight. It was a lot of fun.
Yeah. I mean, investing is I think I'm getting better as an investor now than when I was in the past. I mean, but I've learned a lot of hard mistakes that basically crafted who I am. But I think at this point, I'm getting better. I'm getting better. And I'm getting to the point where I understand myself more than I understand the market, and I think that gives me an edge where I know what my risk tolerances are, what my level of conviction is, and now I look for those opportunities, and I'm okay. This is going to sound really weird, but once you've made it, and you've made really good money in the market and you get to a certain level, things become easier to tolerate when it comes to the downside, where it's okay, whatever, I'm down X in a position, whatever. I still have this giant nest egg on here. Whereas when you're on a small portfolio and you see a position that's halfway, got cut, you feel a lot more nervous about it. And you feel a lot more oh my God. So,
hey, you think what am I doing wrong? What am I doing wrong? And a lot of it is just the market being the market. And if you're doing everything right, I mean, of course people are going to invest in the junk stocks or the pump and dumps where they see a headline, they're like, "Ooh, let me put money in," and they don't do any due diligence, and of course you're going to get screwed on those sorts of things. But if you're doing what Chris is doing, you're doing a lot of your due diligence and you're taking your time,
By the way, I finally said goodbye to the damn SoFi. I transferred out so I had a Roth IRA that I transferred to SoFi. I was like, you know what? Let me try this out. Let's see how this works out. So I tried it. It was good for 10 minutes until I started to try to trade using that freaking app, and it was garbage. SoFi's app, when it comes to the trading, is garbage. So what did I do? I stuck with it for a while, and then I just kind of switched off to Fidelity now, because the options are so limited in the SoFi app that it doesn't make sense to hold the position, hold money in there. And then my bank account, I figured out, dude, I just need brick and mortar for a lot of things. So I ended up, putting my money in my regular account. So it's really interesting. I don't see the moat around SoFi's business. They're executing really well, but there's no intangible benefit that makes me say, wow, everyone's going to switch to SoFi because their product is just this good, and it doesn't seem to be the case. So we'll see.
Yeah, I do think it'll end up being a $20-30 billion bank, which means it'll go up about 200 to 250% from here. So I think it's a good store of capital. But do I think it was the bank? And I could be wrong, and I hope they do prove me wrong, because obviously I have 2,300 shares, which is a small position. But if you think about it, it's I was once thinking that it would be this revolutionary sort of company, and I just don't see it anymore. And maybe I'm wrong. And yes, it's a well-run bank and it's growing very quickly, but is it really going to overpower and be a 200 billion, $300 billion bank? Maybe in time, but it's going to take a long time to get there. And they just got the profitability, right? So,
Zoe asked a really good question. Chris, why were you interested in the past? Was it the valuation at the time? I think it was a combination of valuation and just how upbeat the CEO was in broadcasting his vision. Like sometimes you can get really sold on it based on the leadership of a company. So I was sold on it from a leadership standpoint. So I looked at Anthony Noto and I was like, this guy really knows what he's doing. He's great. Like the problem is even a great leader at the head of a shitty army is not going to be able to fix it. You know, he's a really good leader. I get you can just tell, but he's in an industry that's very competitive. That's just, I don't know how to do it. I don't know how to say it. It's like being the best badminton player. You know what I mean? It's like, wow, this guy's the best badminton player ever. But it's like, who really watches badminton? You know what I mean? Like, you're gonna really put money in badminton?
It'd be much more impressive if you were the best basketball player, which is very competitive.
Exactly.
And you know, a lot of people are trying to just strive for being good at basketball. I know the answer for myself. I use Fidelity for a majority of my money.
Look at this guy. Look at this guy. Look at the question he has. This is the best question to leave this pod with, actually. Okay. Orion, go ahead. You answer that question.
Well, let me answer Junebug's question. So Fidelity is where I have the most of my money, and then I have some direct investments with some companies through computer shares, stuff like that. And I have some Robinhood, and I'm trying to think. I did have Fundrise. I closed out my Fundrise account because I'm using that potentially for capital for this current house. So hopefully I'll get that in early April so I can close on that house if we win the deal. I'm 50-50 if I actually want the house to go through, but I think it's a really good house. Would I rather put that money in the stock market versus this is kind of where I'm anyway, but I'll answer. Do you want to answer the broker's question first, and then we'll move on to this Orion question?
I have Fidelity for majority of my investing. Like my 7-digit portfolio is in Fidelity. The reason why it's in Fidelity is because the broad nature of investments that Fidelity can get you access to. So one of the things that people may not know about me is I don't just invest in stocks. I actually buy bonds and I also buy preferred equity, right? So a lot of people, they just do, stocks and options, which is really good for people with Robinhood. If you just do stocks and bonds, Robinhood is good enough for you. And I do have Robinhood, by the way. So I have a Robinhood account where I also do options and some stocks and stuff, just because the UI is so easy to use. It's so intuitive. I really like it. So, that's another thing. I do have like my 401k, but that's through like this thing called Empower, which is not really like something that I control. It's just my company uses them and they just give you a set of funds to put your money into. And that's all you can do. So that my 401k is in that. And my wife has Charles Schwab because her accounts are loaded through there. So it's like, so I have the full gamut, but the best broker, in my opinion, that I have for a long-term investor who's like wants to be a well-rounded investor is Fidelity. The UI is very clean, in my opinion, and it gives you this wide range of investment options that you wouldn't necessarily be able to get via just Robinhood. So I did some due diligence on, I told you, a commercial REIT that's a property that's commercial REIT, but it also has preferred shares. Now, the thing is, I want to buy the preferred shares, but I can't buy it on Robinhood because it doesn't offer it. Fidelity does. So, so a lot of times, even if I wanted to be in Robinhood for all my investments, I couldn't do it. So
yep. Yeah. For personal savings, I use Amex. They're generally pretty good about keeping up with interest rates. So they keep up with whenever there's rate hikes and stuff like that. They generally keep up with it. But also Fidelity provides their money market accounts are phenomenal as well. So but for me, it's just easier to do direct deposit into a savings, and it's also nice to kind of keep it away from my normal investment accounts that I look at every day, and my savings, I'll just go in there and be like, ooh, I have a couple more thousand than I want in there. So let me just move it over to Fidelity. So that's kind of how I've structured it. Is it the right way? I'd say just do what works for you. But fortunately, UDoc uses Fidelity for their 401ks, and I liked it and kept up with it. And I do keep some money in Robinhood because it's easier to look at options trades through Robinhood, but then I execute them on Fidelity because it's literally just easier to look at the options chain through Robinhood. So even on my desktop, I'll pull up Robinhood because it's literally just laid out so simple. Fidelity is a little bit more difficult. You have to look at the tree, and it just causes too much. You can kind of simplify. You could say, I'm going to buy a put, I want to buy a call, I want to sell, and it like simplifies exactly what you want to see. Versus when you look at it, it's just like you have to look at the bid and the ask and the bid and the ask. It's like anyway.
Yeah.
So, go ahead.
Yeah. Anyone asking questions about bonds, there are some brokers that let you just buy bonds electronically from their trading platform, but bonds are not like stocks. There's very little liquidity compared to stocks. So, the bid and ask prices can be really up there. So I have a bond guy actually. So I literally just call the bond desk. And if there's like a new issuance of a bond of a company that I really like, I'll just be like, hey, can you get me into that? Can you get me an allocation? So they'll get me an allocation if I want it. Sometimes you can buy some distressed debt. And what's good is that when you call the bond desk, they will try to get you the best execution price. So it's not like the stock where you just go and you do a market order and boom, it just drops into your account. With bonds, it's a little bit different. Like you have to also know you have to know a lot more to be a bond guy. Let me just be very, very blunt and just say bonds are not necessarily for retail investors because of the complicated nature that's involved. But at the same time, it's actually safer than stocks. So, I mean, you know what? Let me take a step back. What I mean by that is in terms of total return potential, bonds will always on a general level underperform common equity. All right. So if you just do like a bond index versus a stock index, you're definitely going to lose in terms of opportunity cost. But if you're smart and you know how to pick the right bonds at the right price at the right time, there's substantial amount of returns there, and you can actually make equity-like returns over a long period of time in a very, very safe way. So just keep that in mind.
And the downside's a little bit more protected as well, because like you stated, well, you didn't state it today, but you've stated it well in the past, is you're number one compared to a stockholder who would be paid last in the event of some sort of bankruptcy. So if they were like, we're done, we're closing up shop, they look at the book value of the company and it's like, well, bondholders get paid first, and then anything that's left over goes to the equity guys. Well, unfortunately, if you're equity, you're probably not getting paid. The stock is probably just going to go to zero or fractions of a penny or whatever until they restructure, and they might come out with a new ticker symbol or something like that if they go and they restructure and come out of Chapter 11. But it is what it is. So to answer this question, Mr. Patel, I'll go first. So any thoughts on high yield ETFs like Yield Max? Several are positive since inception, sort of conflicting with NAV erosion argument against those. Many of those that are positive are like
which one's positive?
There's one, and it's because it came out recently, and it's because it's related to Bitcoin. So Coinbase released one not too long ago, and obviously Coinbase has been on an absolute tear. But the thing that bothers me most about some of these things is if you truly want to invest in a company, like a lot of people are investing in, say, TSLY, they're like, oh, but I think Tesla is going to go up 100%. It's like, first and foremost, figure out what you want, right? And this isn't just specific towards Yield Max. This is just in general. You can't have your cake and eat it too, right? A lot of times people will be like, oh, but if I invest in this, I'll get the returns of Tesla and I'll be able to get the covered call income. It's like very rarely will you actually be able to do that in a manner in which you'll be able to outpace Tesla, right? In terms of total return, if Tesla goes in the right direction. Chris, I'm sure, is going to pull up the underperformance of some of these things, like exactly like this. Even if you're investing in Coinbase, the Coney you're way under producing the returns in the long term. You would have just been better off. And people might say, "Oh, but you're not including the yield." This is literally over the past 6 months. So it's like, how much could have Coney have actually yielded in terms of an income stream since then? And there's many examples. If you do for Tesla over the past 18 months, 2 years, or however long it's been open, where it's literally gone down massively. People were boasting how great it is, and even if you compare it to, say, Tesla stock as a whole, you would have just been better holding Tesla.
Where
Um,
is it?
yeah,
Yeah, there's a lot of missed opportunity costs. It's not worth it. I'll be very blunt with it. Don't do yield max. I
yeah,
think it's just a cash grab by people to say, look, we're generating all sorts of return, by doing this covered call option. It's not worth it. You're better off just buying the stock if you want to be speculating on the company. If you really want to buy, if you want yield, just look for some good bonds.
yeah.
That's it.
The thing is with any of these sort of ETFs, instead of listening to, let's say, somebody that's on YouTube, because you'll have me and Chris are against these sorts of ETFs. Then you'll have the exact 180 degrees that are like, I'm boosting my income, I'm using it to buy other stocks, blah, 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 blah. I maybe hear where some of them are coming from, but majority of this is a horrible product. If you look at something like XYLD, XYLG, some of these other income ETFs, I could see a place where somebody might put something like that in their portfolio. That's also a covered call ETF, but it's more balanced towards, and you're still likely to get to underperform the market. Let's just say, for example, because you're writing 100% covered calls and capping. So in the past several months, I'm sure if you look at the past 6 months of, say, an XYLD, which is the S&P 500 covered call ETF versus the S&P 500, you've underperformed probably by 50%. And what I mean by that is we've probably had a 25% rally in the bottom of SPY since October to now. And maybe it's closer to 15. I don't know. But I'm sure XYLD is way underperformed that. And it's because you think about what the nature of a covered call is writing, let's just say, an option for somebody to give away those shares at, say, a higher price. Somebody's paying you, say, a slight premium. But if you go in months where we've been running for the past 6 months, like we have for SPY, you're going to blow through those strike prices and unfortunately cap your gains. So, they're decent during sort of sideways markets where you're able to still attract some income during that time period. They might also help in slightly downward trending. If you're going way down very quickly, like during the pandemic, they were very detrimental to the net asset value of those, because obviously you're not able to accumulate more on the upside. You had that big V-shaped recovery with the S&P 500 during the pandemic, where you went down 30% and immediately came back up 30% almost within the matter of a couple months. Obviously, you're writing covered calls 2% out of the money. You're going to limit your upside when you're having this V-shaped sort of recovery. So you're going to almost retard your kind of your stock price and, say, the covered call ETF. So think about what your objectives are as an investor, right? Is it income? Is it long-term price appreciation? Is it, because you could be looking at it and be like, I just want, say, 4 or 5%. Well, you could buy 30-year bonds right now and get your 4 or 5%, never have to worry about anything ever again, except maybe inflation. But if you're looking to try to have your cake and eat it too through these like yield max ETFs, I think you're going to get slaughtered because you're trying to accomplish too much with one sort of thing. I just beg people, because a lot of people will go and jump both feet into the pool with some of these ETFs. Just do me a favor. Whenever you're looking at an ETF, whether it's yield max, whether it's, even SPY or some of these other things, just read the prospectus, right? When you read the first couple paragraphs of the prospectus about what the prospectus objectives are trying to do, see and look yourself in the mirror to say, is that what I want out of a position that I'm in? And maybe you're too young in your portfolio, you haven't thought about this, but I urge everybody to think about your objective for your portfolio, your time horizon, your risk tolerance, how much capital you're going to add, and how active or passive you want to be. Those are 5 things that I always tell people. And if you talk to anybody at Fidelity or Schwab, they'll probably tell you the same thing, maybe just in a different way. But think about those 5 things for you. Take 5-10 minutes to yourself and answer one of those questions honestly, and not what you want to be, honestly. Because some people are like, oh, I think I'm a day trader. It's like, no, you're not. Like, be honest with yourself. What can you actually, if you can't contribute 5 hours to the market a day, you're not a day trader, right? If you can, then maybe you could say that you could be a day trader. But be honest with what reality is actually showing you versus what you want. And then look at the perspectives of some of these things and be like, shit, why am I in this? It doesn't align with that sort of goals that I'm setting aside for my portfolio. The answer could be yes, right? TQQQ, for example, for me, it's like, people might be like, why are you investing in TQQQ? It's just like, well, it was a $50,000 bet to see that if it goes up, let's just say 1,000% or 6,000%. Worst case scenario, I lose 50 grand. I'm not that upset about it, right? I'm not sitting here thinking it's going to generate me an income. So you have to think, what do you want out of your portfolio, and align whatever you invest into to do it, and don't necessarily rely on, say, a YouTuber who, because let's just be, some of these people are actually very diligent. They have good faith. Like Chris, I think, is somebody that has good faith in what they're doing, and they actually, what's the word I'm trying to say? Take pride in what they're putting out there and what they say, and what they say is what they do, and they'll be honest when they make mistakes. But there are many YouTubers out there that, unfortunately, like Chris is doing this as a hobby. Chris is doing this because he enjoys it. Chris is doing this because he likes doing the DD sometimes, maybe not all the time, because it drives him insane. But I'll get off my monologue in just a second and give it back to Chris. It's like, if you think about what some of these YouTubers are doing, they might not have another job. This might be their only thing that they're doing. And they might just be using headlines or specific ETFs to get clicks. And you have to think, is that somebody you necessarily want to listen to, right? And you might be thinking, I'm trying to attack certain people that I'm friends with. I'm not. There's certain people that I actually trust and do a good job and share news and media associated with stocks and finance well. And there's others that do it just for clicks and aren't actually providing any value. They're actually detriments to your portfolio. And you need to watch out, and you have to realize who's actually there for good faith, that you should keep in your quarter or in your board of directors, if you might say, and who's a wolf in sheep's clothing.
Yeah. There's not really much to add, but yeah, thank you for everyone who follows Cashflow Chronicles. I'm not sure how long we're going to be able to do Cashflow Chronicles, but it's always a pleasure to get an idea, especially speaking to Matt. He's a seasoned investor at this point. I'm a seasoned investor. I would say we're seasoned retail investors. Even though some of the plays that I make are not retail-ish, like traditional retail investors, usually they just look at equities. Like, I don't do that. I go into other parts of the capital structures on companies too. So I guess that would be a differentiator for me. Someone asked a really good question. Can you buy into convertible debt offerings? Sometimes you can, and sometimes you can't. Some bonds are limited to only sophisticated investors. I don't want to use the word sophisticated, but that's what the SEC will put it out as, where you need to have a certain net worth or a net income. And basically, if you don't qualify for that, you are not allowed to buy them. You're not allowed to make even an offer. So you have to be qualified to make that judgment. So I forgot what the rule is actually called. A rule for, let me see, sophisticated investor, accredited investor. There you go. Mm-hmm. Accredited. So if you want to be an accredited investor,
it's what, $250,000 a year or $1 million? Is that what it is?
I'll pull it up because I think so here it is. This is the requirements for an accredited investor according to the SEC. So if you have a net worth over $1 million, excluding your primary residence, so if you have like a $1 million portfolio, you are an accredited investor. If you have an individual income over 200,000, or as a couple 300,000, you are considered a accredited investor. Now, those are just the financial requirements. Then you can also have professional criteria that allows you that. So if you have a Series 7, an investment advised Series 65, or a Series 82, you get, even if you don't have that 1 million mark, you're still considered a what is that thing called? An accredited investor. I think accountants actually get something along the lines too. Directors, executive, general partners of companies selling securities, that gives you the thing. So,
Yep.
you know.
And
So,
somebody asked, why was it made this way? A prime example of this is, say you were to invest in a private real estate investment trust that requires you to invest in real estate, and somebody says, are you sure this is a very illiquid investment? Some people might be like, oh yeah, I'm fine, but that might be the only $5,000 that they have, but they're like, I need to do something. I need to invest. I need to do something. Well, unfortunately, you only have $5,000 and you're not educated in the market. You might be like, I need that $5,000 back. It's like, dude, real estate, that's very illiquid, right? You either need to refinance the property or wait a couple of years for it to not lose money, etc. And it's like that's something where if you get invested in something like that, it's not very easy to get your money back out, versus stocks, very easy. Another thing is, it's like if you invest in, say, venture capital or a private investor, you most of the time need to be accredited, because that also might be a very illiquid investment. It might not also have the approval of an SEC guidance, right? It hasn't been viewed under the lens of SEC to be a public investment or a public company. So, there could be accounting fraud or this or that. There's a lot more risk, and they want to make sure that the SEC and many others want to make sure that you're not necessarily setting yourself up for a failure, right? Somebody with $1 million could probably afford to lose more than somebody that doesn't have $1 million. And that's just, is it the right? Should it be $300,000 a year? Should it be 2 million? Should it be 5 million for the kind of cap? Who knows what the real cap is? But the thought is if you've accumulated $1 million, you probably know a little bit more about money, unfortunately, than somebody that doesn't have two nickels to rub together.
Yeah, and Mithun asked a question: isn't this for private companies? Yes, it is, but it's also guiding certain instruments, also, especially in bonds. Like certain bonds will have it. Like you need to be an accredited investor in order to be in this, because of just the nature of how the security is structured. So, yep. All right, brother. I am out. I'll see you later.
Thank you, my friend. Yep, you're the man. So the last thing I will say, Mr. Patel can sign off, no problem. Speaking of SpaceX, we will have an accredited SpaceX investor on tomorrow, not for Cashflow Chronicles, but I will be interviewing them. And if the interview is good enough and I don't need to tailor anything, I'll probably post that video on Matt Money. Before you guys leave, please do me a favor. Cashflow Chronicles is 9 subscribers away from being at 1,000, where we could officially move this channel and these streams over to there full time. I would very much appreciate if all, say, 140 of you that are watching, 145 of you that are continuing to watch right now, if you are not subscribed to Cashflow Chronicles TV, I will leave the link in the description, as well as put the link in the chat right now. Please take the opportunity right now while we're highlighting it to move over to there so we can go there full time. Let's say maybe even starting next week. And it'll be nice because we literally have all 70 odd streams that we've done to date since about 6 months ago when we started this, all over there. And as I alluded to yesterday, for those of you that are unfortunately hearing this speech 2 days in a row, the topics that we cover might not necessarily be relevant anymore, but maybe the way that Chris and I approach it still is relevant to this day, and it could be useful to something that comes up in the near future. So thank you to the 2 that just subscribed, much appreciated. We just need 7 folks, and much appreciated. We'll be able to connect up and monetize at that point. And as I stated, whenever Chris is ready, we will do our first stream over there. So much appreciated. As always, you guys are absolutely phenomenal. Trust me, it hurts me sometimes as much as it probably hurts you not to have something to do or watch in the middle of the week. So it does hurt me when, unfortunately, we aren't able to go live and Chris and I's schedules just can't hold up. But I appreciate you guys reaching out. I used to get annoyed with the fact to be like, oh, is there no Cashflow Chronicles? I've turned the leaf. I really appreciate when you guys do that, because it means you care. You love the message that we're sending out there. And I love having the conversation with Chris. Sometimes I feel like he's, I hope I give as much value to Chris as he gives to me and he gives to us. And I want you guys to realize we learn from you just like you learn from us. And at the end of the day, I just hope I don't feel like I hope I don't feel like he's a burden, or I'm a burden to him, or you guys are a burden to him. He's obviously very busy. You saw he was taking messages from work. Make sure if you guys are in the Discord to give him some love. Um, he he's a good guy, and I really appreciate him taking the time because I've learned a lot from him, and he's actually made me some decent money. But hopefully, I've made him some money as well. So you know, he doesn't always like my picks, Rocket Lab, Palantir, etc. But you know, hopefully in the near term, long term, you know, I get to meet up with him and again in say Atlanta or something like that on a flight home from. I was about to say what European country, but a European country in the future when I do a little bit more traveling, and also as I go back and forth to Pennsylvania, New Jersey area for just time off and family, etc. So, can't guarantee that we will be on next week. We will probably, I'll be in and out of New Jersey, staying at the beach house for the first time. And then Chris might be doing God knows what as well. So we'll kind of keep you posted. But as always, whenever we have the opportunity, we love doing this, and we hope that you guys learn as much as we can. From each other. This is just a community of love. And if you guys really, let's just say you love Chris's perspective more than mine, that's okay. There's a Discord not in the description, but on his Patreon. And if you guys are interested, him and I are active there. I just do it a little bit more, I guess, casually than he does. He's in there really frequently. So you might say, oh, is he on Cashflow Chronicles? Why isn't he at Cashflow Chronicles? It's easy for him to maybe respond via Discord. Because he might be working or away from his desk or something like that, where he can't be physically here for Cashflow Chronicles, but he might have time for a 1 to 2 minute message or something like that. So if you guys are interested, you know, hang out, check out his Patreon. And yeah, this I feel like will be, you know, a snapshot in time. These things live and die. You know, unfortunately, Chris and I have the ability right now, but literally he was just telling you, like, there was a job I applied to, you know, in a different country halfway across the world. And you know, him meeting me at say 9 p.m. Central Time and me meeting him at like 7 a.m. God knows when time might not have worked, you know. And I thought about that when I applied to the role, and thankfully, you know, things went a different way. But you know, there could be a time where I literally moved to Australia, or I moved to Indonesia, or Chris retires midstream, and like he looks at his account and he's just like, I'm done, and he just quits, you know. It's possible. You know, we're both very successful in what we do, and we've done really well in the markets as well. And I actually find this pretty funny. I had a coworker look out there's like, well, we'll all be millionaires someday. And I didn't say anything, but it's like, oh, the fact that you think so low of me to say someday is pretty funny. But it's a good time, and I really enjoy doing this. I've been doing YouTube now for 6 years, 5 years, something like that. And you know, it's a lot of fun to kind of release and hang out and learn from new people. And the channels changed, the audience has changed as I've changed. You know, I used to be focused on dividend investing, now I'm more so focused on long-term speculative bets for some, and then obviously prudent investing for the majority of folks, right? Because I always generally hone back in, and the majority of my portfolios in the S&P 500, but I do take these small speculative bets. But anyway, as always, I appreciate you guys hanging around. Please do be sure that you do and subscribe to Cashflow Chronicles. We'll be over there eventually in the shorter term, literally just a couple subscribers away. We'll probably start doing streams in a couple weeks over there full time. I will be interviewing that accredited investor that does SpaceX and Rocket Lab investing. So very unique. Be on the prowl for that interview to come out. I don't think it's going to take me forever, but I will be traveling Friday and doing a lot of work Saturday. So I might have some time on Sunday if I don't get it released Thursday evening. But if I don't get it out Thursday evening, I really appreciate you guys. And I'll talk to you guys on the next stream. So thanks so much. And this replay will be on Cashflow Chronicles. And as soon as I hit end stream, it will delist from the Matt Money channel. So I will talk to you guys on the Cashflow Chronicles channel. Till next time. Maybe tomorrow, maybe next week. Cheers.